When we look back then, there were two technology bubbles. There was one from 1914 to 1919, massive bubble in textile. There was a big crash, just like 2000, 2002. And then there was a bigger bubble from 1925, 1925 to 1929, a second bubble in tech stocks. So we were seeing this exponential rise in the Dow and stocks and technology stocks. We had a channel projecting that forward into the top of the baby boom spending around 2007, 8, 9. And we expected this second bubble to be as strong as the first. Well, it wasn't. And what we missed, it was in the roaring 20s, but what we missed was in the new world, people could suddenly borrow against real estate, and the Fed put interest rates down to 1%, and everybody was speculating in real estate. And then China, India, Russia, Brazil had a bubble even bigger than the technology stocks in the 90s. So the bubble switched to real estate, emerging markets, and gold and commodities and silver and oil and stuff. So the U.S. stock market still went up, but it only doubled. We were expecting it to quadruple.
So the bubble shifted.
Yeah, the bubble
shifted. The momentum, the economic momentum shifted,
right.
But it unforeseenly shifted into real estate and that whole credit bubble versus just
we did not foresee, the banks lending 9 times income against real estate instead of three times. That literally happened in 6 years. So that was the new thing.
Yeah.
We say, history repeats itself, but there's always a twist. Well, that was a twist. So the good thing about that, Bruce, was that when in 2006, when I realized, no, this is not bubbling, the stock market's going up. We told people October 2002, if this isn't a buy signal, we've never seen one. Get in. We've got several years ahead. So our people were in the stock market. They weren't losing. It just didn't go up as fast as we thought. So, but I said, why aren't stocks bubbling like they did before? So I, dug and dug and dug, and I actually ended up finding 2 new cycles. A commodity cycle every 29 to 30 years, which is a different clock from the demographic cycle, which is about every 40 years. So in the roaring 20s, the commodity cycle was declining, which is good for the economy. In this cycle, it was going up dramatically, which is bad for stocks.
Right.
We
saw
also
oil go crazy.
Yeah, and oil
during
going
the real estate
up.
boom.
Stock market does not like oil going up, doesn't like commodities going up. But even more important, there's a geopolitical cycle. I had seen somebody present this years before, and I kind of poo-pooed it a little bit. Every 17, 18 years, we have a positive geopolitical environment for stock, then a negative.
Okay.
And so I went back and looked at that, and I said, you know what? 2001, right on key. And ever since 2001 and 9/11, the news in the geopolitical environment has been negative for stocks. When I look back and tested that cycle back, stocks are at half their value in that negative cycle. Even if demographics and the economy is booming, even if it's booming, they're at half their valuation. So that's why, we expected stocks to quadruple. They only doubled. Well, it was still a good market.
Yeah.
And we had people in Asia was one of our key sectors, but we missed the magnitude. But people say, and I also get a criticism, oh, you're too extreme. I'm like, wait a minute, am I extreme, or is the time we're in extreme? Did the Nikkei not go from 40,000 to 7,000 and hardly ever bounce? Did Japanese real estate not fall 60% and never bounce?
What's the VIX today?
Did tech stocks go down 80-some%?
Yeah.
And never come back to their highs. Yeah, the VIX, now it's not 90 to 100. 40 to 50 used to mean you're at an absolute bottom. We're in the greatest bubble boom in history. If somebody, I hate to say, like Abby Joseph Cohen is saying, well, we expect a little moderate this, a little that, and we're adjusting our portfolio 66 to 68% stocks because we're a little more bullish, that's useless. This market, we've had 3 major bubbles, 95 to 99, crash. 2002, 2007, crash. Now, the stock market just doubled in the same time it took in 5 years, 2002 to 2000.
Yeah.
It just doubled in 2 years.
Yeah.
And gold and silver went up
Crazy.
6, 7, 8 times, and on and on and on. We're in bubble after bubble after bubble. If you're sitting there taking a moderate stance, you're the one that's in la-la land.
Yeah.
Yes, in this type of boom, who's going to catch all these magnitudes exactly? But you're right, over time, we said 20 years ago, we're going to see a decline in this time frame. Early 90s, we said we're going to boom. Late 80s, we said Japan's, the most contrary forecast we ever made was Japan in the late 80s was going to go down because people worshiped the Japanese back then. The US said, if we could only be like them. And I'm like, wait a minute, do they lead information technologies? No. They lead old industries. They have an aging population. They're at the top of their game. We've seen the best of them. They're very good. Great economy, great people still. They're still paying mortgages underwater. U.S. people would never do that.
Well, we got a lot to go here, so I'm going to pick up on some other stuff here I want to talk about. I'm going to skip some stuff to save time. You talk about the seasons of the economy. That is in your books.
Yeah.
We won't do a whole dissertation on it right now. But in the autumn of an economy is where we begin to see these bubbles.
Yes.
We see the summer and we see lots of prosperity, and then it just kind of starts to lose steam, and then it bubbles on its way into the winter, if I'm correct about
Well,
that.
actually, summer is when you see inflation like the 1970s.
Okay.
Think of inflation like high temperatures. And then temperatures come down in the fall. That means falling inflation, lower interest rates. You got new technologies in the fall moving mainstream. I mean, computers only moved mainstream in the 90s, 80s and 90s and 2000s. I mean,
Right.
first the personal computers, then the internet, wireless phones, broadband.
That's a summer or
No,
autumn?
that's fall.
Okay.